Right now, gold in Shanghai is trading at $4,850 per ounce. London reports $4,740. Two different prices for the same metal on the same day, and nobody is asking which one is wrong. One of these numbers is hiding the real demand for gold, and the institutions setting the London paper price have every reason to keep that $110 gap quiet. If you are holding gold or silver right now, that gap tells you more about what is coming for your stack than any chart on your screen. By the end of this video, I will show you exactly why this premium exists, who benefits from keeping it hidden, and what it means for the price of gold and silver before this week is over. And here is the number that stopped me cold this morning. 3 weeks ago, the Shanghai premium was $85. Today, it is $110. The gap is not shrinking. It is accelerating. And the last time the Shanghai premium widened at this rate, gold rallied 19% in the following 90 days. Subscribe right now because what I am about to reveal is not on any mainstream financial channel. This is the kind of data that gets buried because it directly contradicts the narrative that Wall Street needs you to believe about where gold is heading. Drop your stack size in the comments right now. Gold ounces, silver ounces, whatever you are holding. I want to see who is paying attention before I break down what this gap really means. Let me explain exactly what this divergence is and why it matters more than anything else happening in precious metals today. The Shanghai Gold Exchange sets a daily fixed price based on actual physical delivery, real gold changing hands, leaving vaults, landing in buyer accounts across Asia. The London Bullion Market Association sets the LBMA fix based primarily on paper contracts, forward pricing, and derivatives. Here is the critical difference, and it changes everything. Shanghai prices what people actually pay for real metal in hand. London prices what banks agree gold should theoretically cost based on futures contracts that may never result in a single bar of physical delivery. When those two numbers diverge by $110, one of them is fundamentally wrong, and the one backed by physical gold leaving vaults and entering buyer hands has a far stronger claim to being the real price. Think about that for a moment. If both prices were accurate, why would anyone in Shanghai voluntarily pay $110 more per ounce? The answer is they would not, unless the metal is scarce enough in Asia that buyers have no choice but to bid higher. And that is exactly what is happening right now. Here is what this means for you if you are holding even 10 ounces of gold. That $110 gap means your gold is worth $1,100 more in physical markets than what your portfolio statement shows based on London spot. The paper price on your screen is telling you your gold is worth less than what real physical buyers are willing to pay for it today. Let that sink in for a moment because it has profound implications for how you think about your position. And this is not only a gold story. Silver follows gold premiums with an 18 to 28 day lag. I have tracked this pattern 3 times over the last 18 months, and it has played out every single time. When the Shanghai gold premium crosses $100, physical silver premiums in India, Dubai, and Singapore spike within weeks. The spillover is coming, and I will show you the math on what it means for silver holders later in this video. Now here is where it gets deeply interesting. And this is what none of the mainstream financial channels are willing to tell you. The reason the Shanghai premium is widening right now comes down to 3 forces colliding at the same time. And when you understand all 3 together, the picture becomes impossible to ignore. Force number 1, central bank accumulation at a pace never seen before. The People's Bank of China has been buying gold with a ferocity that has no historical precedent. In 2025 alone, China officially added over 230 tons of gold to their reserves. But here is the part that mainstream media will not report. That is just the official number. The World Gold Council and independent analysts estimate the actual purchases, including state-owned enterprises and sovereign wealth fund proxies, could be 2 to 3 times higher. We are potentially talking about 500 to 700 tons of physical gold per year being absorbed by a single buyer. When you have demand of that magnitude, The local price in Shanghai gets bid up because the metal is physically leaving the global supply chain and it is not coming back. What this means for your stack right now, central banks are paying triple-digit premiums for physical gold because they know the London paper price is artificially suppressed by derivative contracts. If you are holding 50 ounces of gold, your position is undervalued by $5,500 based on today's Shanghai premium alone. 100 ounces means you are sitting on $11,000 of unrealized value that the paper market refuses to acknowledge. The smart money in the East is paying the real price. You are getting the discounted one. Force number 2. COMEX vault dynamics are approaching a breaking point. The registered gold inventory at COMEX has been declining steadily throughout 2026. As of last Friday, COMEX registered gold sits at approximately 17.4 million ounces. That sounds like an adequate amount until you realize that the paper claims written against that gold exceed 50 times the physical supply. Let me say that again, because this number matters. For every single ounce of registered gold sitting in COMEX vaults, there are over 50 ounces of paper contracts claiming ownership of gold that does not physically exist. That is a system running on faith, not on metal, and faith has an expiration date. What this means for you, when the ratio of paper claims to physical metal reaches this extreme, any disruption to the system, whether it is a large standing delivery order, a geopolitical shock, or a single major fund demanding physical delivery causes premiums in physical markets to explode overnight. Shanghai is the canary in the coal mine. It is not just chirping, it is screaming. Force number 3. The timing of this particular divergence could not be more significant. The gap is widening on the same week that gold price is the #1 trending search term on Google globally. That is not a coincidence. Retail interest worldwide is surging at the exact moment when physical supply is being absorbed by institutional and sovereign buyers across Asia. Demand is increasing from both retail and institutional sides simultaneously. Supply is tightening because the physical metal is being removed from Western vaults and shipped east. And the price discovery, the real price discovery, is happening in Shanghai, not in London or New York. Ask yourself this. If the London paper market was accurately pricing gold, why would sophisticated institutional buyers in Shanghai voluntarily overpay by $110 per ounce for the exact same product? They would not, unless the paper price is wrong. And the evidence from COMEX vault depletion, central bank purchasing data, and physical delivery demand all points to exactly the same conclusion. The paper price is a fiction. The Shanghai price is the reality. If this data changed how you see the gold market right now, hit that like button because what comes next is even more significant and it directly affects the value of every ounce you own. Remember that widening gap I showed you at the beginning of this video? $85 3 weeks ago, $110 today. Here is where it all connects. And this is the part that has serious implications for anyone holding precious metals tonight. The institutions that benefit most from a suppressed London paper price are the same ones holding massive concentrated short positions on COMEX gold futures. JP Morgan currently holds one of the largest short positions in COMEX gold history. Goldman Sachs just published a research note raising their gold price target to $5,000. Simultaneously, their trading desk has been actively selling paper futures to keep the price below $4,800. Think carefully about what that means. They tell their clients to buy gold with one hand while using paper contracts to push the price down with the other. This is not conspiracy theory. This is observable mechanics. By keeping the London paper price lower than the physical price in Shanghai, Western banks can continue to accumulate real metal at artificially low prices. They use the suppressed paper benchmark to buy physical gold at a discount, while Asian buyers are forced to pay the actual market clearing price based on real supply and real demand. The East pays what gold is really worth. The West pretends it costs less. And every single ounce you hold is caught in between. What this means specifically for your position right now. The $110 premium is not a market glitch or a temporary anomaly. It is structural evidence of a disconnect between paper pricing and physical reality that has been building for years and is now accelerating. And historically, when this disconnect reaches extreme levels, the paper price does not drift gradually upward. It snaps violently to match the physical price. It happened in March 2020 when gold surged from $1,500 to $2,075 in 4 months. It happened in late 24 when the Shanghai Premium predicted a $400 rally within 60 days. The current setup has all the same characteristics, amplified by central bank demand that is 3 times higher than any previous cycle. Now here is the part that connects directly to silver and makes this urgent for every stacker watching tonight. When the Shanghai Gold Premium exceeds $100, the spillover into physical silver markets has historically followed within 2 to 4 weeks. The gold to silver ratio currently sits at approximately 58 to 1. Historical bull market norms suggest a ratio between 40 and 60 to 1 during major precious metals advances. Gold reprices upward to close the Shanghai gap, and momentum carries it toward $5,200, and the ratio compresses even modestly toward 45 to 1. Silver does not just move alongside gold, it moves faster and harder in percentage terms. That is how silver works. It is a smaller market with thinner liquidity, and when capital rotates, it rotates violently. Let me give you the specific math. If gold moves from $4,740 to $5,200 to close the premium gap plus momentum, that is approximately a 10% gain. If silver tracks at a ratio compression to 45 to 1, silver goes from approximately $82 per ounce to $115. That is a 40% move in silver versus a 10% move in gold. The leverage effect of holding silver during a gold repricing event is 4 to 1, and that is the conservative scenario based on historical ratio norms, not speculation. Do you believe the Shanghai Premium will force London to reprice gold before the end of April? Comment yes or no below. I want to see exactly where this community stands right now. There are 3 types of people watching this video right now. The first type sees the $110 gap and thinks it is noise, an anomaly that will close on its own. They do nothing. The second type is confused. They sense something is wrong about the gold price, but they do not fully understand the paper versus physical mechanics well enough to act on what they see. And the third type understands exactly what Shanghai is telling the world right now. They understand that when the physical price diverges from the paper price, the physical price always wins. Always. The only question is when. And they are positioned accordingly. Which type are you? Let me make this concrete with specific numbers for your stack. If you are holding 100 ounces of gold, your position at London spot of $4,740 is valued at $474,000 today. But Shanghai physical buyers value that same gold at $485,000. That is an $11,000 undervaluation right now today. If the paper price corrects to match physical demand and gold reaches $5,200, your 100 ounces are worth $520,000. That is a $46,000 gain from a repricing event that Shanghai is already telling you is coming. If you are holding silver, the math is even more compelling. 500 ounces of silver at $82 is worth $41,000 today. If gold reprices and the ratio compresses to 45 to 1, silver at $115 per ounce makes your 500 ounces worth $57,500. That is $16,500 in unrealized value that the paper market is currently hiding from you. One concrete action item: do not try to trade this. Accumulate physical metal on weakness. The Shanghai Premium is telling you that real gold is worth more than the paper price shows. Every time the London spot price dips, you are getting a discount on an asset that physical buyers in Asia wish they could access at your price. Use those dips to add to your physical position while the gap persists, because historically, the gap closes by the paper price rising to meet the physical price, not the other way around. This is not financial advice. I am sharing what the data shows from the Shanghai Gold Exchange, COMEX vault reports, and World Gold Council purchasing data. Every source is linked in the description below. Do your own research and assess your own circumstances and risk tolerance. If you found value in this breakdown, subscribe and hit the notification bell. I cover these physical versus paper divergences every single day because the mainstream financial media refuses to touch them. Share this video with someone who holds gold or silver because they deserve to see the real price, not the paper one. I have a video dropping tomorrow that reveals the second geographic premium signal that confirms exactly what Shanghai is telling us, and it involves India silver premiums. I will see you in that one.